Hey there, and welcome to the channel. If you're new here on this channel, we explore smart investment strategies to grow your wealth and achieve financial freedom. As always, the information presented in this video is for educational purposes and should not be considered financial advice. Be sure to evaluate how these securities align with your financial needs and consult with a professional if needed. Well, on we go. Investors, are you ready to make 2025 your breakthrough year? If you're looking for growth that's bold, innovative, and packed with potential, you're in the right place. Today, we're diving into three exceptional aggressive growth ETFs that could supercharge your portfolio. These funds are carefully selected, not just for their past performance, but for their alignment with industries driving the future. Before we get into the details, let me take you through the criteria that helped us narrow down this list. When evaluating the aggressive growth ETFs, we focused on four key areas. First, we looked at growth potential. This means targeting industries like artificial intelligence, semiconductors, and disruptive technologies that are reshaping the world. Next, we considered assets under management and expenses. Larger funds enjoy greater liquidity, ensuring ease of entry and exit. Lower fees mean more of your money stays invested and working for you. Third, we looked for a strong, liquid options market. This is crucial to use yield enhancement strategies like covered calls and cash-secured puts, or using option strategies to hedge positions. Finally, we looked at historical performance. While past performance certainly is no guarantee of future results, it can highlight consistency and resilience relative to underlying markets. Hi there! If you've managed to stick with me this far and found this material valuable, please like the video and subscribe to the channel. It's a big help. After evaluating countless options, we landed on three ETFs that checked all the boxes. Let's dive into each one. First, let's talk about a fund that's riding the wave of one of the most transformative technologies of our time: artificial intelligence. The Global X Artificial Intelligence and Technology ETF, or AIQ, is a gateway to companies that are pioneering the future. From cutting-edge AI software to advanced hardware, this fund captures the immense potential of a rapidly growing sector. If you're looking to invest in innovation that's reshaping industries and unlocking new possibilities, AIQ offers a front-row seat to the revolution. AIQ's top 10 holdings represent about 36% of its total holdings, with the largest two holdings, Tesla and Netflix, representing 8.3%. Currently, the fund shows investment in 83 companies with a heavy weighting in tech. AIQ was launched in May of 2018 and has over $2.9 billion assets under management, reflecting strong investor confidence. The net expense of the fund is fair at 0.68%. One of the key highlights of AIQ was its total return. In 2024, AIQ delivered a return exceeding 23.9%, which is significantly higher than most growth-focused ETFs. By comparison, QQQ, the Invesco QQQ Trust, which tracks the Nasdaq 100 index, had a total return of 25.5%. While both of these are tech-heavy, AIQ does not have any of the top 5 Nasdaq companies in its top 10, which means there is the potential for divergence as AIQ's picks outperform. This ETF carries a beta weight of 1.25, which shows that it is significantly more volatile than the market and may rise or fall more than the related indices. Additionally, AIQ has a somewhat liquid options market, allowing investors to employ option strategies to supplement income or as a partial hedge of adverse market movements. A covered call strategy, for example, could add current yields over time. Next up, we have a fund that thrives on bold, high-conviction investing, the ARK Innovation ETF, or ARKK. Managed by Catherine Wood, this fund is all about betting on disruptive technologies that could redefine the future. From genomics and robotics to fintech and AI, ARKK invests in transformative industries and high-growth companies like Tesla and CRISPR Therapeutics. It's a fund for those who want to go all in on innovation and aren't afraid to embrace the risk for the potential of outsized returns. ARKK is an actively managed ETF that seeks long-term growth by investing in companies that meet the fund's disruptive innovation objectives with at least 65% of its assets. Originally founded in October 2014, ARKK is a well-established ETF with a strong investor base and managed assets of $6.3 billion. The fund holds over 34 different companies with a high concentration among its top 10 holdings. In fact, the top 10 list represents a whopping 63.8%. The top three positions are Tesla with over 13.7%, Roku with 9.2%, and Coinbase at 8.7%. As expected, with a large concentration in a handful of large potential innovators, the beta weight of ARKK is 2.01, which indicates significant volatility relative to the market. In 2024, ARKK delivered a return of 8.36%, underperforming the QQQ. It's important to note that ARKK is designed for aggressive growth associated with disruptive companies. Holding a small number of concentrated companies based on future disruption can be a double-edged sword, leading to outsized gains when the disruption takes hold, but potential underperformance or large losses when it doesn't or is delayed. ARKK does have an active options market with strong liquidity that would make it suitable for various option strategies, including covered calls, put-selling entry, or hedging strategies. Last on our targeted list is SOXX. The iShares Semiconductor ETF is a powerhouse fund that offers investors targeted exposure to the semiconductor industry, an essential driver of modern technology. From powering artificial intelligence and autonomous vehicles to enabling 5G and advanced computing, semiconductors are at the heart of technological innovation. SOXX includes industry leaders like NVIDIA, AMD, and Broadcom, making it a concentrated bet on one of the most critical and high-growth sectors in the global economy. With its good historical performance, reasonable expense ratio, and highly liquid options market, SOXX is a compelling choice for investors looking to capitalize on the technological advancements shaping the future. In 2024, SOXX delivered a return of 12.96%, making it an underperformer relative to the QQQ. However, given the nature that all technology is based on the semiconductor, it seems likely that SOXX will be well positioned as AI continues to grow exponentially. Originally founded in 2001, and now with $14.5 billion assets under management, SOXX is a well-established ETF with a strong investor base with a relatively low fee of 0.35%. Like ARKK, this fund also holds a concentrated group with only 35 investments. The top 10 holdings represent 59.07%. At the top, some of the biggest companies like Broadcom, NVIDIA, and AMD. Many of these names are well positioned to spearhead the future of artificial intelligence with their chips and software. This fund does come with more volatility relative to the market, as the fund's beta is 1.60. SOXX does show a strong options market with adequate liquidity and open interest. This will be useful for income-producing options, put entry, or hedging option strategies. Now that we've explored these three incredible ETFs, let's talk strategy. How can you make the most of these opportunities? Whether you're a hands-off investor or someone who loves rolling up their sleeves with active trading, there's a way to maximize your returns. First, for those who prefer a straightforward approach, direct purchase is your go-to strategy. Simply buy shares of your chosen ETF and hold on to them long-term to ride the wave of growth. This is especially effective for funds like SOXX or AIQ, which are rooted in high-growth sectors. But here's a tip to enhance this approach. Consider writing covered calls. Selling calls at strike prices slightly above your purchase price generates additional income, while allowing for capital appreciation. If you believe the price to be inflated, consider selling cash-secured puts as a means of entry at a discounted price. If prices drop below your put strike price, you will be the proud owner of shares, but at a price you are comfortable with. You can always sell covered calls on this new position for additional income and as a way to pick an exit point. To wrap it all up, these three ETFs, each targeting a unique high-growth sector, represent some of the best potential for aggressive investors in 2025. Whether you're all in on AI, excited about disruptive innovation, or confident in semiconductors as the backbone of technology, There's an ETF that fits your strategy. For my portfolio, I've started by selling puts on ARKK. Even though I was a late adopter, I am a believer in Tesla and think it could see outsized gains going forward. So ARKK seems like the best fit for me, but I can see the benefits of each. So which strategy are you leaning toward? If you would like for me to review a different ETF, let me know in the comments. Don't forget to like this video, subscribe for more investing insights, and hit that notification bell so you never miss an update. Thank you for watching. Until next time, good luck out there.